So that's what we're going to kind of talk about today is the basics of loans and kind of what you need to know as a realtor. You don't have to figure out any numbers. You don't have to qualify anybody and figure out what a DTI is. But just so you know, a DTI is your debt to income ratio. That's what we work off of. A debt to income ratio is going to be where you have your total income versus your total debt. And that's kind of how we qualify. So when you hear DTI, it has to do with what people can afford, in layman's terms, what someone's going to afford. So what I'm going to do is I'm going to share my screen, but type in questions if you've got questions. Like this is a perfect time. Like you have a lender who just said that they issued a CD yesterday. What does that mean to me? Like those kind of questions, I can translate that into English for you or timeframes. So ask the questions in the chat and then Tom will kind of share, but because I'm going to share my screen with the PowerPoint. And I'll just kind of go through it, but please stop me. Like I'll hear you guys. If anybody wants to unmute themselves and ask a question just out loud, feel free to. Otherwise, I'm just going to feel like I'm talking to myself for 30 minutes. I'm going to share my screen. Okay.
Sure you are. There you go.
Okay. See that? Lending A to Z?
Yep, we're good.
All right, perfect. We're going to start with, well, that. Okay. So I've gotten this a lot the last couple of weeks. Please don't use the term good faith estimate. It doesn't exist. It's like it's a dead word. And I still hear people using it. Borrowers will use it, which I expect them to because they don't know the difference. Or if someone hasn't gotten a loan in the last couple of years, they will still use the term good faith estimate. But that is gone. It's disappeared. Good faith estimate has a big old X in front of it. You don't use that term anymore. What we use is the loan estimate, or you'll hear LE. The loan estimate is essentially what the good faith estimate was. So that your loan estimate is the breakdown of your escrow fees, your title fees, your lender fees, and the setup of an impound account for taxes and insurance. It's the everything, the loan estimate. Now that initially goes out on a purchase, and we'll kind of stick with purchase. If anybody's got questions as far as a refinance, just yell. But your initial loan estimate is always going to be slightly padded because when we request fees from escrow and title, those fees that they give us are going to be disclosed to the borrower. Once those fees are disclosed to the borrower, they cannot go up. They can only come down without a valid change of circumstance. So at the beginning, escrows, titles, we will put in some pads like we don't know what we have to put in, what possibly can be at the beginning. So your initial loan estimate is always going to be slightly higher than what the borrower ends up having to come up with at the end. It's just how it works because everybody's afraid if it even comes higher than what we initially disclose, we have to pay it. So we put on there the appraisal fee. We put on there just in case there's a reinspect fee because the water heater didn't have the second strap, or there's a broken window, or for whatever reason, if the appraiser has to go back out, they charge to reinspect the house. Well, that's on your initial loan estimate. So everything is on that initial loan estimate. So your borrower is going to sign a loan estimate. Typically, it's going to be twice. Once we have the fees from the escrow, and once the loan is locked, there'll be a second loan estimate out, and we call it the locked loan estimate, but it still looks the same. There's just a box that's checked, yes, the loan is now locked. Whereas initially, typically, and initially it could be locked, but most time it's not. Most of the time we will lock like within transactions. So the second one that goes out is the locked loan estimate. That has to be signed a day before we'll get to the closing disclosure, but there's like a time period for these. So the loan estimate goes out first, and then closing disclosure, or CD. That's all anybody hears is CD. That has to be signed 3 days before a borrower can sign their loan docs. And there's no like, but my borrower's got to move in and that's going to push the close of escrow an extra day or two. It's 3 days. So if they sign, but the day they sign counts. So if the closing disclosure is signed on a Monday, we count Monday, Tuesday, Wednesday, Thursday, they can sign loan docs. So if there's any questions about timeframes on specific files, always ask. we'll always tell you like what that translates into as far as like where that can put your potential close of escrow. But it's 3 days. Once the closing disclosure is signed, it's 3 days from then. So if you have a lender telling you the closing disclosure is not out, but we're going to sign or we're going to close on Friday, it's not the case. It's not going to happen because you have to sign it. You've got your 3 days and then loan docs can be signed. Loan docs cannot go out without a closing disclosure signed, period. And there's no wavering on that. There's no exceptions. The items needed for a closing disclosure to be issued is your loan has to be locked. Your locked loan estimate has to be signed. Typically, you're going to have your loan approval, the appraisals in, and your insurance is in. And the insurance, I should have asterisked that because insurance does tend to hold us up. I don't know why that is so difficult. But the insurance has to be accurate as far as the numbers because the closing disclosure, again, fees can go down, but they cannot go up. I do get a question often, like after the closing disclosure or the CD has been out and signed. Sometimes we get calls from realtors asking, hey, they didn't want to do, or the sellers didn't want to do a repair. We're going to issue a credit. Credits are fine. Credits are not going to hold up your loan docs. It's always okay to lower a consumer or a borrower's closing costs. Always okay. So take the credit. If your closing disclosure is out and signed, completely 100% okay to get a credit. So just keep that kind of in mind too. But that's what your LEs and your CDs, you'll hear those thrown around a lot. Ask if you have any questions about what anybody is trying to translate to you, call any of us here at Point. We are happy to translate. Other terms to know, I don't know, like, I'll probably just post this this slideshow for you because I'm not going to go through all these terms. There's 2 pages of them. But CTC is one that you'll want to know. You're clear to close. Clear to close, which I guess I should go back. A closing disclosure doesn't mean you're closing the loan. A closing disclosure just means the fees are finalized, period. You're clear to close right here. This clear to close in red, or you'll hear people just throw out CTC. CTC are beautiful words because that means the loan is cleared. We can go to loan docs, draw them, and we're going to closing basically. So CTC means you're closing the loan. The CD does not. The CD just means your fees are finalized. So just because the CD goes out does not mean the loan is done. Does that make sense for everybody? Oh, well, I can't see anybody, so hopefully it does. Other terms are here. You'll see UW written down often down here. That's underwriter. It's just way easier to write UW than it is to spell out underwriter and quicker. So know what UW is, just means underwriter. And then there's other terms here that just kind of good to peruse and kind of read through. There's basically 2 types of loans that we deal with. We deal with government loans and we deal with conventional loans. FHA, VA, USDA are government loans, and then conventional. Conventional is basically up to 510,000 is going to be your conforming. Anything higher than that is jumbo money, which right now jumbo money is really tough. So yeah, I don't even think we're going to cover jumbo today, but if anybody's got any jumbo questions, feel free to yell because things have changed slightly for jumbo funds with COVID. So those will be questions as you'd have to deal with a jumbo loan or a high-end listing, ask those questions. A lot of times if you've got people coming in with money down, like a 20% down payment or a 15% down payment, we're breaking it up between a first and a second to avoid jumbo. So yeah, that's kind
Okay,
of
Kim, there's a couple of questions.
Yeah.
Bob asked, how many days is a pre-approval good for?
Typically your pre-approval is going to be about 4 months, pending any borrower changes. So our credit, when we pull a credit, it's good for 4 months. What happens is we pull a credit, it's good for 4 months. And then right before funding, we do what's called a soft pull and we check for inquiries. We don't check balances and that kind of thing on current debts. But if the credit's been pulled by Best Buy, we're going to check to make sure a new account has been opened. I say 4 months, but right now with COVID, it really kind of depends on the borrower also. Like if they are working normal job and they're not furloughed, 4 months stands. If they're furloughed, it's going to be different. it's going to change. So a case by case, but basically 4 months, it's good for your credit.
Okay, and then Laura asked, isn't there a conforming loan high balance as opposed to a jumbo that is above 510 in California? Correct?
There is, however, not in Riverside County. So my slides are going to be geared toward, I don't know, there might, I guess there could be some people from San Diego on this call. Orange County and San Diego will have high balance. Riverside County does not. And that's super important. If you are dealing with a lender and they're out of area, they need to know that because it can change that borrower's pre-approval and and maybe the lender doesn't realize they're looking in Riverside County, but the county matters. So it is kind of important that you have a look. Well, I prefer local lenders myself, but yeah, the lender needs to be aware where you're shopping, especially if they're out of area lenders.
Yeah, the Laura that asked is based in Los Angeles.
Oh, okay. Yes, there is a high balance in LA also. Sorry.
Okay, continue.
All right. Basics for FHA loans, and I don't want to bore you to death, but basically an FHA loan is going to be used for somebody who has like maybe a little bit, like their credit may not be perfect. The minimum down payment is 3.5%. And again, down here, Riverside County loan limit, it is different for Orange County, San Diego, and LA. They're much higher. So those are much higher if you're out of Riverside County. But FHA is one of the more forgiving loans. 2 years after a bankruptcy, as long as there was no mortgage included in that bankruptcy, you can get an FHA loan 2 years after the discharge date. Gift funds, we love gift funds. Grandma, grandpa, aunt, uncle, somebody in the family gifting funds is beautiful. And then the mortgage insurance, the big thing for FHA loans when you're comparing, like why would somebody get an FHA loan versus a conventional loan? One of the cons for FHA is that the mortgage insurance is on there now for the life of the loan. So this 0.85, if someone's putting down 3.5%, the minimum down payment, that mortgage insurance is going to stay on there for the life of the loan. You have to refinance to get rid of it. So that's how you do that. That's probably the biggest con to FHA, but the benefits are the lower interest rates, higher debt to income ratios. Yeah, it's a great program, but the mortgage insurance is on there for the life of the loan, whereas a few years back it was not. Eventually it did fall off, but right now it is the life of the loan. I'm going to kind of brush a little bit over down payment assistance. They are still available. I've had agents call and think that because of COVID, the down payment assistance programs are not a go, but they absolutely are. I'm funding one today. So we've got Cal HFA, and we also have Open Doors, which is Golden State or GSFA. You'll hear that one thrown around. Both are great programs. I can tell you a little bit about both, but they each have their own special guides. When we pre-qualify somebody and they want down payment assistance, I kind of keep it a little bit gray and figure out which one's going to work better for the borrower. Cal HFA you end up paying the whole thing back. The interest rates are slightly lower, whereas Open Doors, you can get up to 4%, can potentially be a gift where they don't have to pay it back at all. And then 2% gets paid back, but the interest rates are slightly higher. So it depends on the individual borrower and what their needs are as to which program you're going to go with on those, but they are still there. VA loans are amazing. If you have VA buyers, definitely there's been some old misconceptions about VA loans. Realtors who have been in the business for, I don't know, let's go over 10 years, maybe longer. There are some old like negative misconceptions about VA loans and that they should definitely not be there. VA loans, we have appraisers who don't have to deal with appraisal management companies. So our VA appraisals tend to come in sometimes a little bit better than the conventional ones. The borrower gets 100% financing with no monthly mortgage insurance. So like if you're looking and you're comparing a $300,000, let's say $300,000 purchase price with FHA versus VA, you're looking at about a $300 difference monthly for the borrower on a VA loan, cheaper because there's no mortgage insurance. So no mortgage insurance, we can be as low right now, about a 620. We just got a little bit of forgiveness on our FICO scores. At one point we were at 640 because of COVID. We're down again to 620. So 620 FICO scores are fabulous. VA rates are going to be super low. We've locked a couple this last couple of weeks at 2.375, like beautiful rates for VA. They're same, VA is pretty forgiving as far as like 2 years after a short sale or a bankruptcy. And then, oh, I should have changed that. Oh, no, I did. The conforming, so when you, VA is now allows for you to get 100% financing over the conforming limit, whereas before that used to be called, well, it's still called a VA jumbo, but they used to require a down payment as of last year. This year, they do not. So if you've got a borrower and he wants to buy a 1 point, I've got one right now at $1,095,000 and he's getting 100% financing. Totally fine with VA right now. It's just the rate ends up being, it's still called a VA jumbo because it's over the 510. So instead of like a 2.3, they might be at a 2.7. So the rate is slightly higher, but it's beautiful.
There's a couple of questions. Can you do a VA loan for a refi?
Oh yeah, absolutely.
Okay. And are VA loans different in different areas as well?
Not anymore. Not anymore. They really have it. Because the rules changed as of, I think it was like the beginning of January. You can get 100% up to, I think it's like $2 million with no down payment. Last year, it did differ per county because it was, you had to take your loan, like your limits, and then subtract it from, last year it mattered, this year it does not. Let's keep it there. Simplify. Any more VA questions?
Nope, that's all the questions right now.
Okay, good. Conforming. Most people don't know this either. If you have a first-time home buyer, they can get in with as little as 3% down, which is, I mean, think about this, it's lower than the 3.5 that FHA allows for. So, but most people don't know that, like, and especially like, I hate to like call them this, but millennial buyers think that you have to come in with like a 10% down or more. So it's super important that you as realtors know that if you're a first-time home buyer, you can put as little as 3% down on a conventional loan.
Can you define first-time buyer?
Yes, first-time buyer, and sorry, I kind of used the FTB in my slide, but first-time buyer is someone who has not owned a home in the last 3 years. Okay, so if they sold their house 5 years ago and they've been renting for 5 years, they're now first-time buyers.
I'm sorry.
Hold on. Can everybody mute themselves, please? Okay, not you, Kim.
Oh, I didn't.
Okay, thank you.
Okay, so you've got conventional with as little as 3% down. If they're not a first time, then 5% is your minimum, period. And always up from there. More is always okay. It takes about 20% down to lose mortgage insurance altogether. If someone's putting less than 20% down on a conventional loan, that monthly mortgage insurance that they're going to pay will eventually drop off. They do not have to get rid of it. But when you're comparing conventional versus FHA, the conventional buyer is going to have a much higher FICO score. Otherwise, it's going to make more sense to go FHA. The conventional loan is highly FICO score sensitive. The rate, the mortgage insurance, everything is based on that FICO score. If you've got a borrower or a buyer who is like a 750 FICO score versus a borrower who's 40, well, 640 is going to fit better in an FHA loan. That 740 or 750 is going to make more sense to go conventional. So yeah, you got that. Property types. There's a couple, we've had a couple little snags with property types, and not snags, it's just knowing. Once you know what you're looking at and what you're dealing with, it's great. But all property types are definitely not created equal. Condos, and I didn't even put on here, like in condos, if you have a buyer who's going FHA or VA, the condo HOA has to be approved. How do you check that? You can check that on the HUD website. And you don't have to have a login to check it, and anybody can check it. Or you just call your favorite lender and say, hey, can you check this condo for me and see if it's on the list. But condos, the differences for condos versus like a single family residence would be the insurance policy is called an HO6 policy. The borrower is only getting drywall in insurance. The HOA usually covers the structure itself. This is different for detached condos. There's a lot of communities that are starting to pop up where they're detached condos. Those are treated like single family residences. But a true condo, it's just an HO6 policy. So they're cheaper. They tend to be, I would say, gosh, between $25 and $45 a month compared to like a full homeowner's insurance for a stick-built house around 100-ish. So the insurance is slightly different. The big changes are the HOA certifications. It's required when you're getting a loan on a condo that we have a condo questionnaire and certification filled out by the HOA. Some HOAs do it, no problem. Some are really awful to get a hold of, especially since now in COVID, everybody seems to be remote and working from home. So getting them has been like pulling teeth this last couple of months. So we're trying to request them up front. Some HOAs will not release any information until that seller has paid the upfront HOA fee. So super important if you're a listing agent, you're listing a condo, that seller contacts that HOA and does whatever is needed to help defray the delays, because we're seeing delays all over the place. HOA docs are taking weeks to get instead of just a couple of days because everybody's working remote. So like when it comes to condos, having the seller pay that upfront fee, even when you take the listing, I mean, they may not want to pay, sometimes it's $200, $275, but super helpful. If they're listing it, it's going to sell, have them pay the upfront fee to avoid delays. Things that the lenders are looking for are occupancy ratios, meaning typically they want to see that the owner occupancy ratio is about 51% owner occupied versus non-owner occupied. We're checking for HOA delinquencies. It's important that the HOA is actually solvent and receiving the HOA dues from the other homeowners. 15% tends to, or lower, is super great. And current litigation, this one's popped up a couple times in the last couple of weeks. If there's somebody that's suing the HOA and it has to have to do with anything that has to do with building, it will delay or stop the financing. So current litigation is kind of important also. And again, just if you're the listing agent, please, please, please have those, just warn the sellers up front that they're going to have to pay that upfront fee and see if they'll do it like sooner than later. Otherwise it will delay the close of escrow for sure. Any condo questions? No? The next one's going to be manufactured homes. And I know this is probably going to be more geared towards the Riverside people because we tend to get manufactured homes where you own the land. If the land is not owned, that's a chattel loan. We do not do chattel loans. It's like getting a motorhome loan. So someone's got to go to whoever, like a credit union or someone who does what's called a chattel loan if the space is rented. So you'll find those at the beaches. San Diego, you probably deal with those a lot, but they're chattel loans. They are not real estate loans because the dirt's not owned. The couple of things that need to be known up front, especially if you're writing offers, depending on if the lender knows or you're asking for closing costs. If it's a government loan or if the coach has an addition on it, there has to be a foundation certification, and those run anywhere from about $395 to $450. And then on a manufactured home, there's two little metal tags, one on each coach. Typically it's a double wide or three if there's a triple. There's a little metal tag towards the back. It has to be legible. It talks about the manufacturer date and where it was from. It has to be legible and attached to the coach. And there's an interior tag. This one is just a piece of paper that most people tend to throw away. But if you have someone who has a manufactured home and you're listing it, it's important that they don't throw that away. It's an interior HUD tag. It's just a piece of paper, and it's usually stapled to the inside of a cabinet door or like in the laundry room. I've seen it in the electrical box. I've kind of seen it in different areas, different homes, but it's important that it's there. If one of those or neither of those are there and legible, then we have to order what's called IBET certificates, which ranges anywhere from 150 for both up to about 225 if a rush is needed. Ordering IBET is a 10, right now it's 10 business days with COVID. I think that they're all working remote too, but it's 10 business days standard. So knowing that up front is important. Typically it's a question we ask as soon as we get a contract if we know it's a manufactured home. Yeah, those two things are kind of important for manufactured if you're dealing with those.
Okay, we do have a question from Krista. If escrow falls through, can the seller transfer the upfront HOA fee to the buyer, to the new buyer?
I don't know. I think that has to do with the HOA. Well, the upfront fee is the seller paying it to start processing the paperwork. It's not for the buyer.
Okay, so can it, with a new buyer, can they transfer it, the documents to the new buyer?
Oh yeah, I think so. They're generic. It's not per buyer. It's like when the seller starts the process, it allows them to, it like basically gives the HOA authorization to give the lender what they need. Otherwise, I think it's a privacy issue.
Yeah, I think that's what the question was. Krista asked it, but I think that's what the question was.
Okay, I believe yes. That's why, like sometimes, like I've got some agents who work out of Canyon Lake, and their sellers will do it up front because like Canyon Lake requires an inspection. There's all kinds of other stuff. So when someone sells a house in Canyon Lake specifically, the sooner the better. You know, you don't need it for the. I mean, you do if it's a condo, but even there, anytime you list a place in Canyon Lake, they're going to do an inspection, like it's almost like an exit exam for the seller. I know.
It is.
Yeah. Life of a loan, and this looks just pretty wordy, and I apologize, but I started typing it and I was like, I don't know how to make it pretty, fit it on one slide. Right now, I would say like, typically we can close escrows pretty quick. I would say between 21 and 25 days, we can do pretty quick. Right now during COVID, please try to do 30-day escrows. It's not that we can't do them sooner, but everybody seems to be delayed. Just a day or two here, a day or two there. The 30 days is getting to be a little bit more realistic. With rates as low as they are, we're inundated. Purchase business is booming. And then people are refinancing. So all lenders are they're slammed. All appraisers are so busy that their turn times are starting to be pushed out a little bit. I would say appraisals are taking about maybe 8 to 10 days instead of 7. We were getting them pretty quick, and now we're getting just pushed maybe a day or two out. But those day or two outs from the appraiser, the day or two out from escrows, the day, you know, everything's being pushed a day or two out. So 30 days is more realistic than the shorter escrows. I don't know. We can kind of go through this. No. Yeah, I'll kind of zip through it. But basically, don't start shopping. Don't put someone in your car right now unless they've been pre-approved. And by pre-approved, I mean, not just a conversation, but you've got the credit report. I've got income documentation. You want all of that information in before especially in light of our pandemic, we'll call it our pandemic. You want to pre-approve. Don't waste your time showing property to someone who, one, may not qualify for that house, or two, may not qualify for that house, any house you're looking at.
Can I interject on that?
Yeah.
Okay. Yes. I mean, the goal of CAR right now and the DRE is to stop people from just going out and looking at 10, 15, 20 homes. They need to be ready to pull the trigger before they look at homes. So recommended from CAR is like 2 or 3 homes that they've looked at online. They've already been pre-approved. Certainly pre-qualified, but pre-approved would be way better. The intent is to limit the amount of going in and out of houses.
Yeah, totally. But I got a call yesterday that we're in escrow. They haven't been pre-approved, but they're, call them now and get it going. Yay. It happens. I mean, don't walk away from business, but try to get them, even if they insist that you have to go out, call in the car. Put them on speaker. They may not want to do that, but have them call on the way, 10, 15 minutes on the phone. At least we can get some basic information from them. And we can tell you, okay, no, they should be okay in that ballpark, or no, turn around and show the community next door. That's $100,000 lower.
Well, one quick, actually 2 people asked the same question, is what's the difference between pre-approved and pre-qualified?
Pre-approved means we actually have the documentation. So, and credit's been pulled. A pre-qualification, I can take just on a piece of paper and figure out some rough numbers. That's pre-qualified, meaning that they told me they make $45 an hour and they work 40 hours a week. So I believe them and I write the numbers down and I tell you what you qualify for. They told me their bills were $850 a month. And so that's those are the numbers we use. A pre-qualified Qualification is just numbers that are given to us by the borrowers, which may or may not be accurate. I will not issue a pre-qualification letter to anybody who's self-employed. I won't do it, because self-employed people have to qualify with their tax returns. So unless I see tax returns on a self-employed person, I just will not issue anything. Pre-approved means I've got credit report. I've verified that their pay stubs show that they make the $45 an hour, but they really only work 35 hours a week. So I'm going to adjust. It means we've verified. So approved is much, much stronger than a qualified.
Okay, thank you. Continue.
Yeah. Okay. Okay, fully executed contract. Let's go there. So fully executed contract, escrow's open. Please make sure when that happens, you forward that executed contract to your lender. It does kind of happen sometimes where the contract gets sent to like the TC, and it's been 3 or 4 days, and all of a sudden their realtors call in saying, has the appraisal been ordered? And I'm like, oh, are you in contract? No, it has not. So it's super important that you include your lender, even when it's opening. Just throw the lender on there if that's kind of the easiest, and everybody knows who everybody is. That would be beautiful. Once the contract's at escrow and escrow is technically open, then what we do as lenders is we're going to request the fees from escrow and title. And while we're requesting those fees and waiting for those fees, we're scrubbing the file to make sure that the pay stubs aren't outdated, the bank statements aren't outdated. If we're missing any documentation, we're chasing it down from the borrower. Once the fees come in from the escrow company, then we're going to issue initial disclosures. Once that borrower has signed the initial disclosures, then we're going to order the appraisal. We're going to submit our underwriting. That's like, it's kind of our go time. Disclosures are signed, go, go, go for us. But typically the appraisal is not ordered until those initial disclosures are signed. Because in your initial disclosures, there's an intent to proceed that allows us to order the appraisal. Underwriting turn times right now for purchase, roughly about 48 to 72 hours. On a refinance, like 7 days, but that's typical right now for the industry. But purchases are still about 48 to 72 hours, which is 3 days max. So if I submit a file on Monday, Tuesday, Wednesday, by Wednesday night or Thursday morning, I'm going to have that in my hands. When an approval gets issued, it's always, not always, 99.9%, it's a conditional approval. There's always going to be conditions on that approval. So I know I've had some agents question, well, it's conditional. They're always conditional. There's always going to be a corrected HUD, the evidence of insurance, a current step. Like there's always going to be condition on that loan approval. You just want to know if there's anything critical. So that's what the question you ask. Do you have loan approval? Yep, got loan approval. Is there anything critical? Is a solid realtor question for a lender. Any critical items on that approval? That's the best question to ask if you're a realtor and you're talking to your lender. Everybody at that point is chasing down everything. So we're chasing stuff, escrow's chasing stuff, and the borrower's chasing anything that they're being asked for on the approval. Your loan being locked, I put that here. Typically I lock after I have loan approval. However, depends on the market. Right now rates are pretty solid. They're not real volatile. So I tend to lock after the loan approval. So if there's any changes, we can make adjustments at that point. But different lenders and different loan officers will lock at different times. I don't like to lose locks. So I tend to lock probably about midway through a transaction. Once that locked loan estimate goes out and it's signed, the day after that is signed, that is when the CD can be signed, as long as the appraisal's in, the approval's in, insurance is in. Insurance tends to hold us up too. So if you've got insurance, that's always helpful. Escrow asks for it, we ask for it, and it's just something that falls by the wayside. So usually when I start with the borrower, I give them homework when they go into escrow. Their number one homework, and I usually say in a week, I need it within a week. That gives us plenty of time to get the evidence of insurance out so we can do the CD in a timely manner. But insurance, shopping for insurance does tend to hold us up at the end. So we try to get it within about a week of opening, but not always. That's in a perfect world. Once the CD is signed, your closing disclosure, you can sign loan docs 3 days after that. However, the CD going out again just means the numbers are finalized. It does not mean you're clear to close. So clear to close is kind of, you're looking for the CD. The CD is important. You want to know when it went out. More importantly is when it was signed, because if it goes out on Monday and it doesn't get signed till Tuesday, Wednesday, Thursday, they can sign Friday. It only when it's signed, it matters when it's signed. So the second important question to ask your lender, whoever you're dealing with, is when was the CD signed? Issued is great, but if it wasn't signed, it doesn't help. It's the sign date. Once the loan docs do go to the escrow company, escrow is the one who usually will coordinate the loan doc signing. We try to stay out of it so we don't muddle the appointments and mess that up. Escrow does it. They send out their notaries. They get the docs back quicker that way. Escrow then typically is going to take those signed loan docs. There's stuff that they do to them as far as signatures and figuring. They scan them, email them into the funding department. Right now, funding, we need about 24 hours to review docs and issue the funding checklist. And then we can usually fund, I would say within 24 hours of signing loan docs, just depends on what time loan docs go back. So if loan docs go into funding at 5 o'clock on Tuesday, we're probably not funding until Thursday. So just if anybody have questions on that, it's usually about a 24-hour turn time. If loan docs go in Thursday morning at 9 o'clock, no problem. We'll be closing on Friday. That's kind of how that works. When we call it, we'll call and let you know that we're funded. And then recording, you know, we tell borrowers recordings when they your realtor gets to coordinate your keys. And then everybody wins. Realtors get paid, lenders get paid, borrowers get keys.
Okay, so I've got 3 questions here.
Yeah.
Number 1 is, when an interest rate is locked, how long is the lock good for?
Okay, there's different answers for that. So a typical lock period is 30 days. You can lock for 45, you can lock for 60, you can lock for 15. I don't like 15 because 15 days goes really quickly. And if there's any kind of hiccup towards the end, you're gonna have to pay extension fees. 45 days gets a little bit more expensive than the 30-day lock. So 30, I'm gonna tell you, is normal. Is your normal like quote. Some will quote like 60 or 90-day locks, but those 60 and 90-day locks are expensive. They cost more than locking for 30 days. The shorter the lock period, the cheaper the rate, basically the rate cost. So if you can lock at 15 days and you're confident you're going to close like in 7, then you're good. But 30 is you're going to be your typical lock.
Okay, so then there's a follow-up question. What is the cost of a lock?
That's going to be, there is no cost of the lock. It doesn't cost money to lock in a rate unless a borrower chooses, and this is going to sound a little bit confusing. Borrowers can choose to lock with a discount. They can lock at par, and they can lock with a lender credit. So those are 3 different ways. I guess I'll add a slide for that one. And a discount doesn't mean it's cheaper. A discount means it's a lower rate, but it's going to cost more money. So a discount, when it comes to lending or locking in an interest rate, means you're going to pay more to lower that interest rate. So it's actually quite the opposite of a discount. But, par means it doesn't cost anything, and they're not getting a credit, and that's I would say that's 9 times out of 10. Most of the time, that's where we're locking on at least a conventional loan. If you can also go higher in your interest rate and get a lender credit. So the higher you go in interest rate, there's a premium. The bank's going to pay, like, there's a credit if you decide to go with the higher interest rate. That higher interest rate, that credit goes to the borrower. It's a borrower credit to offset and lower closing costs. So but it actually physically doesn't cost money to lock your loan. Like, it's not like a processing fee of $200 to lock a loan. Is that?
Okay. Yeah. There are a few questions still coming in. Ben is asking a great question because this is regarding the contingency removal, and you know where I'm going with it. When is it really safe to release the loan contingency?
I don't like to ever, but I don't like it ever, but not with a CD. But because that's the question I get. So it depends on that approval, that appraisal, and any contingencies. Like, if there's a contingency for the sale of a property, never. Because if the money's coming from the house that they're selling, never. If we have loan approval, there's no red flags, the loan's been locked, the appraisal's in, you're pretty safe to release loan contingencies. However, like, unless you're being asked, don't ever offer it.
But if they send the notice to buyer to perform to,
Yeah.
at the 21 days to release the loan contingency.
Yep. Yep. As long as the approval's in, it's been reviewed, there's no critical conditions on there. Like sometimes we have, especially now with some of the changes with COVID, you know, you've got a furlough and they were furloughed and there might be a question on income documentation. If there's anything like that, I'll tell people to wait, you know, give us an extra 2 days to get it signed off by the underwriter. But yes, once you have your loan approval, all conditions have gone in, your appraisal's in, you should be clear at that point to release your loan contingencies.
Okay. And then Joni asked a question. I'm going to answer this if you don't mind. Feel free to pop in on it,
Sure.
Kim. But should you always wait for pre-approval before showing properties, or is a pre-qual good enough? Okay, the intent right now, the further into the process, the better. Under COVID, what they are trying to stop is people going out kicking tires, comparing areas, things like that. So the further they are into the process, the better. So a pre-approval is definitely a better time to show. However, we don't live in a vacuum. If all they've got is a pre-qual and they want to look at properties, if you don't show them to them or start working with them, they're going to bounce to another realtor who does not have the same high standards. So, you know, you do the best you can to get a pre-approval. That is the intent of what CAR is pushing for. However, once again, we don't live in a vacuum. So the big thing is that it's just not somebody going out thinking, oh, we're thinking about moving. And we don't know if we want French Valley or West Murrieta or Canyon Lake or Lake Elsinore or Corona, et cetera, et cetera, et cetera, and looking at 20 different homes, and they haven't even started the process. That's what they're trying to stop. They don't want people just going in and out of homes due to the risk of exposure. Okay. Kim,
Yeah,
did you want to add to that?
I will add to that just because, like, especially when you have a buyer like that looks like they're looking from Corona to San Diego, it's important that they know what they're looking at. Like if there's going to be an HOA, if the property tax 2% or they're 1.2. New builds tend to have high taxes. And then you've got HOAs. So like, it's important that they've at least had that conversation with the lender so they know that their payment's going to be $2,500 or if it's going to be $3,500 based off just the location and what, you know, condos have sometimes HOAs in the $700 to $800 range, or the stick built house that doesn't have the HOA. I mean, like it's an important conversation for the buyer to know, and it helps guide them and pinpoint where they want to be too.
Yes, and actually the way to handle that is if you get a lead, whether it's from Facebook, whether it's a referral or whatever, just tell them, you know, they're talking about moving to the area and all that stuff. Great. And you can blame COVID all you want. You know, people, yeah. You throw COVID in there, they'll back down and just say, okay, the next step is I'm going to have my lender, Kim England, give you a call. And she'll discuss the different loan options so she can find out and help narrow down the price that we're going to be looking for. And don't just say, here's Kim England's number, because they won't make that call. If you say, I'm going to have Kim or whomever you use at Point Mortgage, then Kim or whomever will make that call and just tell them that is the next step in the process.
Yeah.
Okay.
And it's not real painful. I mean, maybe 10, 15 minutes on the phone. It's not super painful. You know, it's just a conversation, and we can get a lot out of that conversation that you as a realtor may not. So when they're talking to you, it's kind of fun. You know, they're looking at houses and they want 4 bedrooms and a pool. Whereas like when they talk to us, it's more black and white. It's more about, okay, here's the numbers. I don't want my payment to exceed this. Okay, I may have an issue on my credit. They're not going to tell you that they may have issues on their credit. They're going to tell me that though. So the information that they give us is totally different than the information that they give you. So it does kind of complete the whole package after they've had the conversation with us versus just having the conversation with you. So it is super helpful to actually everybody involved. That way, you know, okay, that issue that they put their, okay, so this popped up today. they need a house. They're selling a house and they want to move. They're selling their house in Lake Elsinore and they want to move to Canyon Lake. Perfect. They should qualify for about 600,000. We go to pull credit, their house in forbearance. That's going to stop and delay everything. And you never would know that unless you had the conversation with the lender. So like, that's a whole nother can of worms, but house goes into forbearance, but they want to sell it now and then take their equity and go buy over here. That house, person has to be out of forbearance and have made 3 timely payments to qualify. It delay you by 3 to 4 months.
Wow.
Super exciting.
Yeah. And Joni, the next question that you asked, and we're gonna let Kim get on with her presentation, that's actually a question for like the Monday mentee meetings. So because that's getting into escrow fees and all of that now, that most of that has nothing to do with the loan. Okay. Okay, Kim, it's all yours again.
Okay, last thing I have for you, I know it's almost at the hour and I start to lose people. So is just to let you know kind of what we have to offer you as realtors. Flyers galore, which I don't know if you're really putting flyers up, physical flyers, but you can use these on social media, virtual open houses, whatever we can do to help you and your business and grow your business, you need to just ask. Hey, I'm struggling with this, or do you have, we've got list reports, we've got Surefire, we have, I mean, like we just have the tools to help. We're using another program, I just blanked out on the name, but we've got like multiple programs that do, I don't know, we can do videos, we can do flyers, we can do social media posts, like whatever we can help you guys, just ask. There's always something that we can do to help boost you.
Okay. Boy, this is a good question. How do we get set up with a rep? I think he means loan officer.
Loan officer? Call.
But
yeah, you're just gonna call. It depends on like where you're out of. There's like my office, and I'm out of the Menifee office. There's probably, gosh, 50 loan officers out of the San Diego office. We have loan officers in Bakersfield. They're everywhere. Florida, wherever you need to be. We've got them there. It's going interview lender. Decide who you think you mesh with, who you get along with, and you don't feel like you're tied to one person. It's not like, okay, that's my person, that's the only person. I would like you to only use me, but it doesn't work that way. If you have a borrower that is going to work with me, then call me. If you have a borrower that is going to work great with Brett, then call Brett. You're not tied to one person. It doesn't matter what office, what area. We all work in California, and we're all happy to help.
I'm going to give a testimony. I mean, Kim has been doing my loans for how long now? 15, 20 years? 15
I know.
years. Sure. You were like 12 when you started, I think.
Right.
But the Menifee office for Point Mortgage, the LOs there are great. So like Kim said, whomever you mesh with. And I will tell you this, list reports, talk to whomever you want to over there. I think you're all set up on list reports, correct? Kim?
Yeah. Oh yeah, I think so too.
Okay, so and get set up on list reports because there's a lot on there, and there's going to be things that you can post on social media that are just good advice. Some of it fun, some a little more serious, and it's a great resource. But definitely for marketing materials, definitely talk to your LO over at Point Mortgage. They've got a lot of resources.
Yeah.
Okay.
Yeah, especially if you're stuck on social media. A lot of super easy, cute little flyers in that list reports that they post new little social media, like cute stuff about your credit and your house, and stuff that you can just throw up, and you've got easy material to throw up. Don't reinvent the wheel. Steal it.
Yeah. Does anybody have any other questions?
I do. Can you hear me?
We can hear you loud and clear.
Hi, Kim. This is Guy.
Hi.
How are you?
Good. Congratulations on your sale, your close.
Yeah, Kim and I collaborated, and we just closed yesterday. And you were awesome. I felt like that little kid in the back seat saying, "Are we there yet? Are we there yet?" And she was patient and really nice. So I really appreciate that. But I had a question for you about homeowners insurance, because when I let's say day 7, I asked the client, make sure you have the insurance and you got a quote. And I assumed, and I shouldn't have, that was proof of insurance, but it wasn't. So what exactly should I have told my clients? And make sure you get a quote and you have to have that proof of insurance. Is that correct?
Yeah, but the borrower doesn't necessarily get the proof of insurance. Typically, you'll hear EOI. That's just evidence of insurance, but it sounds fancier. The borrower gets the quote. The quote goes to the escrow company. Escrow then orders the EOI, or the evidence of insurance. So that's where it ultimately comes from. However, sometimes, like when the borrower just gets a quote from the insurance company, if they didn't say, okay, State Farm, I'm going to use you and I'm buying the policy, like they have to say, yes, I want this policy, then escrow can get their evidence of insurance. But a lot of times they say, here's your quote. Escrow goes to get the insurance and they're like, well, the borrower has to call because they didn't tell us they want us to be their insurance company yet. So it's an open line of community. It's got to be like an open line, like, okay, here's the quote, but then, okay, borrower, sometimes the borrowers just need a little fire, like just a little, little bit.
Okay. And then the last question was the very last part, the last day when buyer signs, and then it goes back to you, right, for funding.
Right.
And then title gets it. Title's the one that actually records. Is that correct?
Correct.
Okay.
Correct.
I just wanted to make sure, because I have to explain that. I want to be able to explain it the right way. Okay.
Yeah.
Thank you.
Yeah. No, it funds and then records that title with the county. And that's when it funds, I tell people that's 95% of the way that you're 95% done. And then recording is actually your 100%. You're done. And then work out those keys.
Thank you.
And sellers, just before we fund, when docs go back, it's also important that sellers kind of stay alert, because there's a couple things that the sellers have to sign before we can fund. So if you are a listing agent and you've got your sellers going out of town, make sure they're accessible, because we do need, like, small things like the grant deed, little things, but super important things. They're not little things. I'm being sarcastic, so I apologize. But it's important. So sellers need to be alert towards the end also.
Thank you.
Yeah.
Hey, anybody have anything else? Well, we're just almost at an hour. So Kim, thank you very, very much.
Yeah, you're welcome.
You did very well. You should do loans for a living.
Thanks. I think I'll try that.
Okay, give it a go. Okay, so without further